Good morning, ladies and gentlemen. My name is Marcy Lungua, agribusiness program leader at Invest in Africa, and I'm glad to be hosting you this morning as we discuss about investor readiness coaching for Agri-SMEs. As a way of introduction, IIA, a private sector partnership initiative that's focused on driving economic growth and job creation through Qatar economies, and the mission of enabling trade between SMEs and large corporates. This is through enhancing SMEs. Our target by 2025 is to create 250,000 SME jobs and to facilitate $1 billion contracts won by our SMEs. We do all see through our three initiatives. That is one, access to skills. That is through the business linkage program, whereby so far we have been able to train 1,000 plus SMEs and 63 SMEs. And in terms of tracing anti-bribery compliance solutions, 63 SMEs have been with anti-bribery certification. And then on access to market under the Biashara on our platform by Invest in Africa, we have links on 4,000 plus SMEs and contracts worth $154 million won by awarded to the SMEs, and so far I've been able to create 88,000 plus jobs within our networks. And finally, on our third initiative is access to finance, whereby this is through the Biashara.now platform by women SMEs in Kenya. $1 million finance accessed by women SMEs in Kenya. And overview of the IIA in partnership with the Masterclass series. We offer SME survival toolkit. This is delivered in with SMEs in our offices in Ghana, Senegal, and Kenya as well. Through this, we deliver four toolkits. That is one, masterclasses, which this one falls under, which is part of this. And on this, is the masterclasses, they are tailored to the need of the target SME groups to enhance recovery and build resilience. Secondly is the coaching session. This whereby SMEs are supported to develop and implement practical and personalized plans. Match SMEs cycles to facilitate business-to-business linkage, peer-to-peer learning, and mentorship cycles. And fourth, the resource center, where SMEs can access best practice business guides and resources. And finally, through the access to finance, where investor readiness program to enable SMEs to access financing. And our discussion today is on Qatar Cross 1, 2, and 4, where you can look through the overview of the toolkit that we offer. And then our SMEs, the masterclass aims to address 4 specific questions. Among them, one, why are the youth and Agri-SMEs not able to benefit from the many funding opportunities? In this, we are looking at what are the funding gaps between the Agri-SMEs and the funders and the investors in position do wrong when seeking funding or investors for their businesses. And that, how best can they structure their businesses to be investor ready? Ladies and gentlemen, today we are joined by Valerie, who is the founder and director of Jenga Capital. In terms of profile and career growth, Valerie is the founder and director of Jenga Capital, which is a finance firm focused on providing capital to agribusinesses capital to agricultural businesses in Kenya. Prior to joining Jenga Capital, Val has worked for impact investment advisory firms in Toronto, and she has also worked at Equity for Tanzania, an equipment leasing business manager. Val has started a career in investment banking at Canaccord Genuity and was involved in mergers and acquisitions, restructurings, and corporate finance deals. And lastly, Val holds a Bachelor's of Business Administration in Finance from Wilfrid Laurier University. At this point, ladies and gentlemen, I introduce to you our speaker, Valerie, to take up the discussion on investor readiness. Welcome, Valerie.
Thanks very much, Mercy. I hope everyone can hear me okay. I was struggling to hear you a little bit, Mercy, but hopefully everyone can hear me and can see me okay. I'm not very good with sharing screens, so let me just try to figure out how to share my screen here. Okay, for this presentation. Can everyone see the screen, my PowerPoint so far? So thank you very much for including me today. It's an honor to be able to speak to you. As Mercy said, my background is mostly in finance, and I am here in Nairobi, but I also used to work in Tanzania, where most of the businesses that the company I was working for there were within the agribusiness sector. And with Jenga Capital today, we are focused on agriculture. So I will do my best to address some of the questions that Mercy had raised, but most of this will kind of be talking about my own experiences as an investor, things that I see, things that kind of things that I look for, and just kind of suggestions for you all as you are looking to finance your business. I'm not entirely sure about the stage of your businesses and the different types of your businesses. So not all of this might not be applicable, but if you do have any questions, please feel free to, I think, add them in the chat, and then, or feel free to kind of jump in and ask any questions if you're unsure. So yeah, I'll just give you a bit of a background on Jenga Capital. So we provide investments to agricultural businesses here in Kenya. Our investment size is 100,000 to 300,000. We do provide funding in US dollars and also in Kenyan shillings. As Mercy said, I've been here in Kenya since the beginning of last year. And since we ourselves are still relatively new to the Kenyan landscape, we prefer providing debt investments. If your businesses are earlier stage, a debt investment might not make a ton of sense for your business. So some of my experiences or some of the companies that I've invested in or the situations may not be 100% applicable. And for me, the things that we look for, we're looking for experienced management teams, and we are trying to kind of build long-term relationships with the companies that we are investing in. And so I think from what I understand, the main point of this session is to kind of help everyone figure out how to access capital. And there's a lot of capital out there, but I think there's a bit of a disconnect between finding that capital and between the investors and the entrepreneurs. So I think before you start looking for capital, taking on outside capital, there's a lot of responsibility that comes with it. So before you do that, you need to figure out your plan. And you need to figure out, okay, why do I want this money? What are the implications of taking on that money? If it's debt, you will have to have quarterly repayments or monthly repayments. And so if something goes wrong, are you able to kind of keep that up? If you need to put up collateral, is that something that you're willing to risk in case something goes wrong with your business? If you're taking on an equity investment, you are giving up some ownership in that business. That means you're giving up some decision making. Is that something that you want to do? Before you go to any investor, I think you also need to think about what are you looking for in a financial partner? So there's all different types of investors and there's banks as well, or different sources of capital. So if you go to a bank, the support that the bank can give you is very different from maybe what an equity investor could give you in terms of kind of ongoing long-term support or guidance. So before you start going out to all different investors, you need to figure out what am I looking for in a partner here? Is it somebody that's going to guide me, that's going to maybe provide connections to different markets, or will provide me connections to different larger companies? Or is it purely a financial partner that you're looking for? And in that case, is maybe a bank a good option? You also need to think about how much money you are looking for and where that money is going to go. So I've seen a decent amount of entrepreneurs that come to me and say, we want 100,000 or whatever it is in working capital. But that's quite a large amount of money to go towards kind of a bit of an opaque or not very clear idea. So you need to think about in your own plan, how much exactly do you need? And then also probably add in some buffer because things will not always go according to plan. Things will take a little bit longer. If you're purchasing equipment, maybe some of your customers won't pay you on time. And it's always a good idea to kind of ask for a little bit more than what you have initially budgeted. And you need to know exactly what you're going to spend that money on. And also, if you're looking for equipment, for example, you should know exactly what type of equipment you are looking for, how much that's going to cost. If you're importing it, how much that costs, how long that's going to take. So these are all really important things that you should do before figuring out, before reaching out to the investors. As part of your plan, you also need to understand and think about how this additional funding will impact your business. So if you get $100,000 US, how will this increase? How will this improve your business, or where will the stresses continue to be? So if you get more money in working capital, so that's great. You can pay your suppliers maybe a little bit faster, but do you have enough customers that having that working capital will actually increase your revenues? Do you have a large enough team that having that increased in working capital will it be too much for your existing team to manage? So you need to really think about kind of, if you get the money, what will this allow your business to achieve short-term, medium-term, and long-term? And again, just also reflecting back, what have you accomplished so far, and what are you looking to accomplish in the future? So making sure that you have key goals and milestones for yourself, and that you can properly kind of explain to an investor saying, this is what we have accomplished, and this is what happened. We started out in 2018 or something, and this is what we have done for the past 2 or 3 years. This is how many customers we have now. This is how many people we're supplying, et cetera, et cetera. And it's really important to understand the different types of investment that you may receive into your company. And so, And so I'm not sure how familiar everybody is with the different types of investment, but there's very different implications of debt versus equity. So basically debt is you're taking on a loan. So it's the very similar concept as going to the bank and you ask them for a loan and you have to repay it back at a particular point in time. You can structure the debt investment very differently if you're dealing with a debt investor as opposed to a bank. So maybe you would pay back quarterly, maybe you would pay back monthly, maybe you would pay back at the end of the full year. But with debt, there's implications of you have to have enough cash flow that you can guarantee that you are making those payments. Also with debt, you can have secured or unsecured debt, meaning if it's that maybe some investors will require collateral, maybe others won't require collateral. All things for you to think about. Equity is a very different type of investment. So that's you are giving somebody ownership, you are giving somebody shares in your company. So they have control over that percentage. So if you need to vote on a decision and they own 60% of the business. Depending how you structure things, their investment, their position may allow for things to head in one direction compared to the direction that maybe you had initially hoped. Equity investors are usually much longer term investors. The way that an equity investor makes money is if another investor comes in and buys their shares, or also if you have dividends in the company that you can repay. So the difference between a debt and an equity investor is really, really large, and also taking on those investments are very different. Equity, you don't have to repay that amount back to them, but you are giving up control, depending how you structure it, of your company. Then there's grants, which is basically an investment into your business, but you don't have to repay that at all. The grants, and you don't have to give up any ownership. Getting grants, I think, can be quite challenging as well. There's lots of grants that are available, but usually with grants, there's a lot of reporting requirements. Same with debt and equity as well. There's a lot of reporting requirements, but grants will kind of depend on, your business will have to be specifically operating in particular areas or focused on different stakeholders in order to be applicable. Then there's other types like a convertible debt, which is a hybrid of debt and equity. Safe note is a very similar thing to convertible debt as well. And royalties is you would get the investor would get repaid using a percentage of your total revenues or something like that. So just all of this to say, there's very creative ways that you can structure different investments, but I think I lost you. Can you hear me now?
Yes, we can hear you, Alar.
Okay, sorry. So when did you lose me? Was I basically done with the previous slide? Had I gone through this already, or do you need me to repeat this? Hello?
Yes, we can hear you. I think you can just continue with the different type of investment. I think you are finished up on that.
Yeah, I had finished, so I'm just wondering where I was cut off.
As you are finishing on the different type of debt. Sure.
Okay, so yeah, as I said, there's convertible debt, safe notes, royalties, where that's a percentage of maybe revenue or of your net income that's paid to the investor. So all of this to say, it's just very important for you to understand the different types of investment and what that means for your business and for you personally. So what do investors want? I think it's really important for you to understand that that different investors will want different things, and different investors will be focused on very different things. Some are very growth oriented, so more traditional equity investors will care about the long-term growth and viability of the company. They will want to make sure that the business can scale. Right now, if you're operating in one county, they want to see, okay, in 6 months, you'll be able to operate in 6 counties, and in 2 years, you'll be operating in 5 countries, for example. There's other investors that are more impact oriented, so they care more about the social impact. So they care more about who your end consumers are or your other stakeholders or the number of jobs that's created. There's investors that are more financially oriented, so they care more, or their top priority is making money on their investment. There's investors that are shorter term oriented. So for example, probably most debt investors have a shorter term horizon, whereas some equity investors are longer term. Some investors will say our money can only be used for working capital. Some investors will say that that the money can't be used for working capital. Some will say it's only for CapEx, etc. And so it's just, you need to understand what the investor is looking for. And as I said, try to find that right match to be able to find a good match and be able to align what you want and also what they want. And some investors will be a mix of these things, and some investors will have different profiles or different funds or pieces of their funding that may have different implications as well. So before you go to the investors, you want to do as much research as possible. So as I have been saying, you need to know what you want and also what you can offer them. So you need to understand, why do you want to work with this investor? As I said, are you aligned? So if you are very impact oriented and they are more financially oriented, that might have challenges in the future when you're trying to make decisions about kind of saying, do we expand out to this customer segment where maybe we would, they're bottom of the pyramid, so we might not be able to make as much money because we couldn't sell our products to them at as high of a price, but from an impact perspective, it has a ton of really great impact. If they are more financially oriented, that probably would cause issues. Again, you need to know if they're short-term or long-term, how long you're going to be working with them for. And you need to understand that taking on an investment, you have to provide communication and updates to them all the time. So depending how they structure things, you will need to provide them with financial updates and operational updates on a monthly or quarterly basis. And so you want to make sure, and some of them may sit on your board. Some of them may just observe your board meetings. It may be formal or informal. So going into an investment, you need to understand and be happy with the person that you will be working with. And again, before you go to your investors or to reach out to any new investor, figure out what type of investment you want, figure out the terms that you are willing to accept, or also the ones that would be too much for you. So for example, if you don't want to provide any collateral, then you need to know that before you get into these negotiations or discussions with the investor. If the highest interest rate that you could afford or that you want to pay is, call it 13%, then if someone's offering you 20% or whatever it is, that's an easy one, because you will have done your homework and you say, nope, this isn't for us. And then you need to also be able to explain what is unique about your business and why should the investor work with you. So for example, if you are an export business, exporting avocados, there's a lot of businesses that are doing that. Why should the investor provide funding to your business as opposed to another business that's quite similar? What is it about your suppliers or your customers? What is it about your management team? So you need to be able to really kind of sell them on that. And you need to also be able to explain how you're planning on paying the investor. So, and as I said, a debt investor will get repaid with a schedule. So if it's interest, or if you're paying quarterly or monthly or whatever it is, again, you need to understand that and kind of go to them with that ask. Or if it's a more traditional equity investment, what is your plan for growth over the next 3-5 years, whatever the long-term horizon is, and how will that investor make their money as well. So for me, I am a debt investor, so there's different things that I would be looking for than with an equity investor. So the things that I ask businesses as part of my due diligence, I want them to tell me what type of investment structure works best for them. So I don't know what their harvest cycles will be or their seasonality will be. So they need to tell me okay, we can repay you in the months of May and we can repay you in the months of September, for example. And so they put together that initial structure. I also want to know how much money they're looking for and where that money is going. So the use of proceeds. I want to understand who their customers, who their suppliers are. I will speak to their customers. I will speak to their suppliers, do reference checks there. I'll want to understand kind of their customer diversification and supplier diversification. If they've had challenges with the customers or suppliers, what the repayment terms are. I'll also want to understand how the business has been financed so far. So if you've received grants in the past, if you've received bank debt, or if it's just been your own money that's been put in. Especially as a debt investor, if there is funding from the bank, then I'll want to understand, okay, when do you have to repay the bank? Because usually a bank loan would be prioritize a loan from me. I would want to understand your historical financials as well. So what has your business accomplished financially in the past couple of years? And how are you projecting the business to be growing? And for me as a debt investor, one of the things that I care most about is the cash flow. So I need to make sure that that cash that the business is generating will be able to support the debt that I'm providing to the business. And I want to understand the company's biggest challenges currently, and then also challenges that they've had in the past and how they've overcome some of those challenges. A challenge that I often hear is people say they don't have access is cash flow management or working capital is their largest challenge. But for me, I feel that kind of working capital challenges, if you don't have access to capital for your working capital, then your business can't grow, but your business should be able to kind of continue to motor along at the same rate if you are able to manage your cash flow properly. So you should understand the cash flow timings and the payment timings from your suppliers and your customers and adjust your business accordingly. Again, if you are looking to grow, I can understand those challenges, but working capital is kind of the main challenge that most people tell me. And there's always more to that story. And then I also want to understand who's on the management team and what is their experience, and kind of how the management team works together and who the employees are. Things I look for that I don't necessarily ask. So these are kind of some of the most important things to me. As I said, you will be entering a relatively long-term relationship with this investor. So for me, I think communication is the number one thing that I look for. I do not, if I have to continuously follow up with the company, that to me is not a good sign. I look to them to be proactive about communicating. If there's challenges, if there's delays, whatever it is, I want to know about it. I don't want that information to be hidden from me. So that kind of goes hand in hand with the next point, openness and transparency. I think if you are struggling to have communication, if you're having communication issues at the beginning of your relationship, then those challenges will only get worse. So I think it's very important to make sure that you both can communicate well with each other. So also it's not just the company that I say, I also look at myself and I say, okay, how can I communicate better? What am I doing? What am I saying that isn't clear? How can we kind of settle these challenges? Other things that I look for is a clear vision. So companies, for me, especially as a debt investor, again, this is a little bit different for an equity investor, but I want to make sure that the business, if you're an avocado export business, you are not saying, we're going to expand into all of these 500 other products in the next year. Like that is just not super realistic. And I think that can also kind of muddles your vision a little bit. So I look for businesses to have clear vision and very attainable goals as well. Again, as a debt investor, I look more short-term compared to equity investors. So that would be different. And then I want to make sure that you understand your market and you understand your customers. And I want to take a look at your, as I said before, customer and supplier diversification. So what's the risk there that if you have one customer and something happens to their business, then does that mean your business also will face challenges? And then also problem solving skills and kind of negotiation skills. And so that I look for when they're talking with me and we're trying to kind of reach an arrangement, but then also I want to understand the problems that they have faced in the past and how they have solved them. So what I would suggest to you, I don't really know your businesses or what stage your businesses are in, but I would say that you really need to understand your cash flow and understand kind of what type of investment you can or cannot take on at this time and when you need that money to come in. Establishing a budget is really important, not just for the investor, but for yourself. And then to keep track of your spending and your revenues or your sales versus that budget. So that when you are putting together budgets for the investors, you can say, okay, we thought we would grow 6 times from last year to this year. Actually, we grew 3 times. Okay, so maybe for next year, we'll kind of reduce our estimates by half again. And creating goals, I think, is really, really important, and especially SMART goals. So the acronym of specific, measurable, attainable, relevant, and time-based as well. So you can have short-term, medium-term, and long-term, but you need to associate and attach specific times. So you say in the next 6 months, in the next year, in the next 2 years, so that you can go back and you can compare, did we hit those goals? Investors will look at due diligence documents as well. So your financials, they want to look at your licenses, customer records, etc. So you can start to, depending when you are looking to speak to investors, you can start collecting that information. You can put it together in a data room like a Google Drive or something so that they can easily access that. And then there's a bunch of different investment readiness programs that you could join. Again, I think you would have to apply, or maybe you have to pay for some of them. But there's ones online to kind of help you figure out how to make your business, specifically your business, how to get it more investor ready. That one I do struggle with because, as I said, investors care about so many different things. So, but I think those programs offer a lot of guidance and a lot of support and a lot of templates that you can kind of help to structure your company and the documents. And then there's also advisory and consulting firms where you can hire them and they can help you reach out to the investors on your behalf. So you will probably pay them a percentage of the proceeds, and they're usually paid on a success base. So as long as you and they together are successful at raising funding, then they will get a percentage of that. But some of these investment readiness programs and some of the advisory and consulting firms are supported by NGOs. So you might not have to pay, it just kind of depends on them. And they will also help you put together your due diligence documents and maybe financial models, and help you kind of have the negotiations or figure out the term sheets and everything. And so there's a ton of resources that are available. Like there's different, again, depends on your stage of business, but there's lots of co-working spaces. Pre-COVID, they were everywhere. I think they're still around, but you can be in the same area as other early stage businesses. And these co-working spaces like Ikigai, Nairobi Garage, for example, they will often offer support to the entrepreneurs, or kind of have sharing circles, basically, where people can say, oh, this was a really good resource and I learned about this, and they can share it with other early stage businesses. There's different types of investing conferences where you can go and you can meet other investors, or you can present your business as well. So like SandCalp just happened. Then there's AGRF, which is specifically for agriculture businesses. That was in September last year, I think. Then, as I said, there's advisory firms. There's cross-boundary, private equity support, and telecap. Again, these are just some of them, but there's lots of these advisory firms. Then there's different accelerator or incubator programs. So there's Antler, there's Growth Africa, YGAP, E for Impact, Then there's international NGOs that kind of will provide technical assistance or can support, especially for agriculture businesses. So TechnoServe, SNV, or MEDA. And then there's just various networks for you to be aware of. And you can also take a look on those networks' website, and you can see all of the investors that are part of the networks. And then you could kind of start doing your research on some of those specific investors. Yeah, so I think that's it for the formal part of the presentation. I think these slides will be shared with you potentially, but these are some key terms that I think people should be aware of. So when you're trying to figure out what investment works best for you, I think if we go into it now, we won't have time to go into each individual one. But these are important terms that you should have an understanding of. And Google can be your best friend on trying to figure out what these terms mean. Yeah, so that's the end of my formal presentation. But if you have any questions, even not just right now, but as you are all going through your investment discussions, please feel free to reach out to me. I hope Mercy can share my email with you. I find if you add me on LinkedIn and you want some help that way, just tell me that where you have come across me before, if it was from this presentation, and then I'm happy to chat with any of you about your specific business.
Thank you so much, Valerie. Awareness creation and head up on what really investors look at. And in terms of the key takeaways, what came out clear to me is that one thing that as an out to a financial and investor, it's quite important to have 3 things in place. One, know why you're going to that particular investor, and know, and should also be able to know if what you're going to seek for from them is aligned to what they do, and also it's aligned to what you do. Are you guys, are you as you as a business and you as a financial, your potential financial, are you working in the same direction? Just that this will not break you down in terms of discovering that you went to the wrong financial or went to the wrong investor. To have your financials record, and if it's a new business, it's important that you also get to understand place in the marketplace. It's important to sit down with the financial and the investor. They're able to take you through on what best will be the best financing or investment opportunity for you in the institution. And maybe Valerie could give you like 10 minutes before we dive into the question and answer forum, to maybe give a brief in terms of what the different types of investments that are there, so that the businesses sitting here today will leave out here having a complete brief of what to look for from the investors.
So I think the one slide that I had, the difference between debt and equity, I think, I don't know how familiar everyone is with debt or equity, but the one slide that I had, so debt, as I said, is a loan. But again, you can kind of get different types of debt. So you can get bank debt. I'll turn my video on. You can get debt or a loan from a bank. You could get it from Jenga. You could get it from other investors as well. When looking for a loan, you want to understand what are the repayment terms. You want to understand what the duration of the loan is. So do you have to repay everything back in 1 year, for example? Is it 3 years? Is it 5 years? Are you making monthly payments that are equal amounts? Are you paying interest only? Other things, obviously, you need to understand the interest rate also. So the interest rate is the amount that that the investor or the bank makes on giving you that money for that year or 2 years. Other things with debt that you want to understand is the collateral requirement. So if sometimes you would need, a bank may require collateral. And so that collateral could be a house, it could be your other assets. And so sometimes if there is collateral, then that would be considered a secured loan. Some loans can also be considered unsecured, so there's no collateral. However, then the interest rate will probably go up to compensate for that. When negotiating a debt agreement, you would probably need to have some type of debenture or some type of charge, and the charge would be put over your land or property, and the debenture would be holding basically over your assets. So if something does go wrong and you aren't able to pay the bank or the investor, then they can take over the assets of your business, or your personal assets, whatever you've put up as collateral. Often people will also ask for personal guarantees as well. So if the business can't make the payment, then you as an individual will have to make those payments. Then I guess that's probably it for debt. I don't know if there's specific questions about debt investments. Then there's equity investments, which, as I said, is more about someone purchasing shares or ownership in your business. And so with that, you are giving up more decision-making ability, probably, but you don't have specific repayments that you have to make. So from an investor's perspective, there's very different strategies for a debt investment versus an equity investment. Debt in general is considered less risky, but then as a total return from an investor's perspective, you get lower returns. Equity investment is much more risky, but there's also more upside depending how the company does. Equity investors will get repaid when somebody purchases their own portion of that company, their own shares, or also through dividends in that company as well. Most equity investors will want to be involved in your board. They will want to be involved in maybe not day-to-day decision-making, but pretty big decisions. They will want to be able to voice their opinion or to vote on that as well. And with an equity investor, it's a much longer term investment typically. So it's also really important that you pick an equity investor that has maybe expertise in other areas that your management team doesn't have. So for example, if they have connections to very large businesses or large potential customers or suppliers for you, they can provide those introductions that way. And yeah, so I think those are kind of the two main things. Then there's convertible debt or safe notes, which are pretty similar to each other. But basically convertible debt is debt, but instead of having to repay the company at the end of the term, that means that it can get converted into equity if the company or if the investor wants, depending how the agreements are structured. So the business will accrue interest, and then the accrued interest plus the initial principal amount, which is the opening amount of money of debt that they will have provided, will be converted into equity, or it could be repaid. I would say, depending on your stage of business, converts or convertible debt or convertible equity also. And safe notes are pretty common in very early stage businesses. Safe notes, there's a lot of discussions about safe notes as well. They're very, very simple agreements and documentation. They're similar to a convert, but there's actually no debt obligations involved. But you're kind of pushing the discussion about the equity or the valuation of your business later. And then the royalties is something else that I mentioned, where you are maybe depending how you structure it, but once your business hits revenues of a certain amount, then you will have to pay 1% or 0.5% or whatever it is of your total revenues to that investor, maybe up until a certain amount, maybe for a duration of time. Again, these are kind of all different structures that can be had between the investor and the company. So these are just kind of the main building blocks, I would say, to be able to understand the concepts. And then from there, you can kind of come up with creative solutions that work for everybody. So hopefully that kind of answered your question about that, Mercy.
Yes, it did, Valerie. Thank you. There's a question in the chat box that is asking on most of the use, and actually, let me say, most of the use, they don't have collateral, just items like land title deed or something to attach as a security in terms of when they're sitting institutions. What do you find? What plans are there? Or let's say, if, for instance, an Agri-SME comes to you, who is a youth, come to Jenga Capital looking for financial loans for investment for their business, and in terms of when you're looking through their document for security, financial deed, or something to attach, what advice would you give them, or what will you yes, in terms of advice, what advice would you give them, or what would be the way forward with the engagement?
Well, again, it depends on the investor that you're talking to. So if you are looking for a loan and your business has the cash flow to support that, then that's fine from Jenga. I think maybe banks here prefer for some type of collateral. But there are other financial institutions or other investors where you don't need collateral. But as I said, the way a debt investor makes money is with that interest that's being charged. And so from the investor's perspective, you have to say, okay, what is my risk tolerance here? If they don't have collateral to offer me and they don't pay me, what will happen? So because there is no collateral, the investor views it as riskier. And so if it's riskier, they want to be compensated with higher returns. So likely the interest rate will be higher. Things could also be structured in a way where you say, okay, we won't provide the full amount right now, but we will provide a smaller portion of it. Then we will hit these milestones, et cetera, and then more money will be dispersed. So it just really depends on the investor and how you can structure things with them. Again, if you're early stage, you probably don't want to take on a lot of debt because if you don't have the cash flows to support the business, then that's not a good situation for the debt investor or for your company either. And the earlier stage your business is, the more risky it seems. And again, if there's no collateral to kind of help the investor feel comfortable with that investment, then it might not be a good fit. And then maybe you would want to look more for equity or convert. Again, the convert is or the safe notes are relatively good options for earlier stage businesses because it allows some type of money to come in. And you're kind of pushing your payment obligations down the line. Whereas debt, you would probably have to start paying relatively soon after you receive the funding. So I can't speak to all institutions or all other financial investors. From my perspective, when I try to work with businesses, I try to structure investments that work for them and also for me. So some of the loans that we have provided are secured and some of the loans that we have provided are not secured with collateral.
Okay, thank you. There's another question from Angela. And she's asking, what has been a great hindrance for Agri-SMEs in assessing funding? And from your experience, Valerie, have you, what in your experience have you seen mostly as being a hindrance to investors?
So I think that for Agri-SMEs, because there is a lot of seasonality or harvest cycles of their business, or there's big swings in working capital, that kind of more traditional bank loans don't necessarily work that well for them if they're structured in a way where they have to pay equal amounts every single month, for example. So I think that's a challenge. Again, from my perspective, I see that there's a lot of investors, especially here in Kenya, and I think that there's challenges accessing or connecting the investors to the entrepreneurs, because I think investors are trying to find deals, and sometimes the investors are pre-COVID. I think investors were kind of trying to find as many deals as they could. Whereas now with COVID, they're more supporting their existing portfolio. And then the SMEs also want to find that access to funding. I think one of the challenges is that the amount of funding that the SMEs is looking for is relatively small in comparison to how a traditional investor makes money. So there's a lot of work that goes into things from the investor's perspective in terms of doing due diligence and paying for legal costs and everything. And so with an investment, you want to make sure that you are still making money, or you're not losing money on those investments. So they're kind of covering the costs of that investment. So some investors will, like myself, will have minimum investment sizes. So I think that has been a struggle. I think there's creative solutions around that, where maybe you could kind of work with different organizations where you say, okay, I will provide funding to this organization, and then they can distribute it to these 3 or 4 SMEs. In my experience, the biggest challenge that I have had with companies or people that have reached out to me, there's lots of people that have reached out, but there are not a lot of companies that are following up. There are not a lot of companies that I say, okay, put together the proposal, tell me what you want from Jenga. This is how much Jenga can provide. You tell me what works best for you. And then I would want to have kind of an open dialogue where we figure out what works best. There's a lot of companies that say, okay, I'll get back to you in a week, I'll get back to you in 2 weeks, whatever it is, and then I never hear from them again. I think I do ask a lot of questions. I think I probably ask more questions than a bank might. And so I'm not sure if that's the challenge, but I think that a lot of the companies maybe haven't really thought about getting their documentation or getting their kind of all of their information available, so that when an investor is ready to go, they can actually provide the answers to the investor's question. So that's from my experience, kind of the main challenges for me when working with businesses. So I hope that answered your question, Angela.
Okay, thank you, Valerie. And having not, there being no other question, I'm projecting Valerie's email address for those who, if you're interested, to connect with her and to get to learn more about Jenga Capital in terms of their financing and investment opportunities and criteria. You can reach out to Valerie direct through via Freshia at jengacapital.com. Thank you very much.